right. I know I'm a grifter strong man. You could lick your hand and smack me in the nutsack. Thank God for Tesla my Esla and you strong man.
Holy smokers! Corsair, my horse here, what up today? Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a fake boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to analyze the earnings of Corsair. Because apparently I found out that old Corsair stock went up by like 15% today. Holy smokers, man. So let's go ahead and pull up Corsair, my horse here at the stock. And then we're going to go look at the earnings. And look at my earnings, guys. Look at my portfolio, bro. It's up 7% today. So, as we all know, Jeremy LeFuFu, who smells like pee-pee, is a huge fan of Corsair Gaming. Why? Because gaming is the future, bro, or something like that. And apparently they just released Q3 earnings, and the stock went up like 19%, which is pretty freaking crazy, right? But if we zoom out, never freaking forget that old Jeremy LeFuFu was buying Corsair at its absolute peak. Look at that absolute collapse of this stock over basically the entire time that it was publicly traded. This was a clown market stock, okay? It looks like it was started publicly trading September 25th, 2020. That's what it looks like here, at least. It rocketed up because we were in a clown market. Everybody thought it was the future, bro. LeFuFu was raving because it had massive revenue growth when we were all locked down and everybody needed stuff to work from home. And we had stimmy checks and child tax credits. Remember that? And Corsair did well, and they even became profitable for a little bit. But ever since then, it's collapsed, okay? So Corsair went up today. So Jeremy's a genius. Buy his course. Give him all your money. And I'm a fool and a moron. Now, here's the third quarter financial results, okay? And you're going to notice a trend here. For example, net revenue, and we're going to go to the projected. We're going to look at the projections in a second, but I just want to show you a kind of a trend here. Net revenue was $311 million for the quarter, compared to $283 from the second quarter of 2022, which revenue went up because remember, during the pandemic, revenue was massive and then it collapsed. So it's not hard for Corsair to recover some of those losses. Okay. But that's not the real problem with Corsair, as you'll see. And $391 million in the third quarter of 2021. So year over year, their revenue is down by a pretty significant amount. It dropped from 391 to 311. Why? Because last year we were in the clown market and it was very easy to see. But you'll see as you go through, you'll see that revenue is up from the prior quarter, which means growth, my oath, right? But it's also well below what it was during 2021. And that makes perfect sense for me. Now, when you read the earnings, they keep saying that there was a massive earnings surprise and Corsair had positive earnings per share. You got to be careful with that crap because I believe they're talking about adjusted earnings, which is BS fake earnings. They just add some expenses back. Oh, it's the adjusted earnings. It's profitable. I'm pretty sure they had a loss, but we'll see when we look at the financial statements, okay? So we go down and they give us their full year 2022 outlook. And they have some discussions here. They're having some headwinds with, current foreign currency being weak versus the US dollar. I get it. For the full year 2022, we currently expect net revenue to be in the range of $1.3 billion to $1.37 billion. We go look at the prior 2 years, okay? This is Corsair. Look at that massive decline in revenue, okay? They had 1.1 billion in 2019 before the clown market. Then they had 1.7 billion. Then they had 1.9 billion in 2021, and now their revenue has absolutely collapsed to 1.3 billion. Now, this seems like more healthy growth because if you draw a line, going from 2019 through 2022, going from 1.1 billion to 1.3 billion is not that bad. As a matter of fact, let's give them their best case scenario, 1.09. So over 2020, over 3 years, they have roughly grown their revenue total by 25%. That's not really growthy to me, if you know what I'm saying. If the pandemic never happened. But I don't know. I guess it's the future, bro. So let's go ahead and look at the financial statements because I don't really care what the company says or the earnings or blah, 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 blah. It's all about the financial statements. Okay. Now, remember, they said in their earnings release, or at least I saw a couple articles that said they had positive earnings per share, adjusted earnings per share. Because we go down here and we see their net loss was negative 5.9. Is that million? $5.9 million. And then you have some non-controlling interests. Net loss attributable to Corsair Gaming, $6.2 billion loss for this quarter. Okay. Don't trust those articles because they will manipulate and say, oh, it's positive adjusted earnings per share. Okay. So overall, their, earnings per share was actually negative 9 cents per share. Always keep that in mind. Okay. So let's go down the income statement and we're going to look at some metrics here. So we can see revenue year over year is down. That makes sense. We can see cost of revenue is also lower. That makes sense. Let's see what their gross profit margin is. Their gross profit is basically, if they're buying and selling hardware, it's the price that they sell it for minus the price that it costs them to ship in and buy the hardware. That's your gross profit. That's before you even talk about selling general and administrative expenses, R&D, interest, and taxes. So it's better to have a higher gross profit because that leaves you more wiggle room with other expenses of your business to become profitable. Usually a low gross margin business, it's hovering very close to unprofitability at all times, which is a little scary to me. Okay. Now, gross profit, 71,560 divided by 311, 769. So their gross profit was 23%. Now let's go look at the history of their gross profit margin. So in the past, during the pandemic, their gross profit went up to 27%, and that allowed them to become profitable. Before the pandemic, 2019, 2018, their gross profit was 20%. So if this trend continues, they've actually marginally improved their gross profit, which actually isn't a bad thing. Okay. Let's go look at some of the more recent quarters. Gross profit margin 23, randomly 12, 23, 23, 25, 27, 30, 26, 28, 25, blah, 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 blah. So if you compare it to the pandemic, their gross profit has collapsed. If you compare it to before the pandemic, it's actually slightly improved. So I'll give Corsair a little check mark there. Okay. Let's keep going. All right. Operating income. So their operating income is their gross profit, which we just talked about, minus selling general administrative expenses and product development. That's what it looks like here. So as you can see, because their gross profit was only 71 and they had all these selling and product development expenses, I guess research and development, their operating loss from their business was almost $11 million. Now, why is their operating profit or loss negative 11 million, but their net income only negative 6 million? Well, they got some kind of tax benefit here, okay, to the tune of $6 million, okay? So their actual profit from their core business before interest and taxes was negative 11. That ain't so hot. So their operating margin was negative 10, 988 divided by 311, 697, negative 3.5%, which is, roughly in line with Corsair, my horse years past. Divided by 311, 769. And after that tax benefit, their loss was negative 2%. And if you go back and look at the history of Corsair's profits, they're actually going back to where they were before. We can kind of see that. Let's see. Profit margin. Yeah, they had low negative profit margins before the pandemic. So they're kind of reverting back to where they were before. Okay revenue growth. So gross profit. Not that great. It's improved a little bit. And low single-digit losses on profit margin. Okay. And we can see that they have negative free cash flow margin, at least, or, very low free cash flow margins before the pandemic, but that massively improved, of course, during the pandemic. Let's keep going down. So let's go look at the balance sheet, okay? So on the balance sheet, we can see, let's compare total current assets. I like to look at total current assets versus total current liabilities to see if they're going to go bankrupt within a year. Well, they have total current assets of $515 million and total current liabilities of $325 million. Now, that seems impressive, right? They have more cash and cash equivalents than they do short-term debts. But an issue I see is they seem to have a lot of inventory on there. They seem to have, looks like half of their current assets is inventory. So if they have trouble turning this inventory, and they may run into, liquidity issues and have to borrow money and pay interest, which will hurt their profitability. So you can always look at the current ratio, and then you can also look at the quick ratio. The quick ratio, and I guess we'll just exclude restricted cash, is a more stringent current ratio. It tells you whether a company is likely to go bankrupt within a year. You take the cash, and we'll exclude restricted cash, plus receivables, plus short-term investments, which they don't have, divided by current liabilities. So their quick ratio is only 0.66%, or it's 0.66, sorry. So the inventory is the big thing that's going to determine whether they're going to have to borrow money. Can they churn this big inventory balance and, convert that to cash quickly within a year to maintain their, plumbing of their day-to-day business? All right. Now let's compare their long-term assets to their long-term liabilities. I like to see long-term assets that are greater than long-term liabilities. Why? It's like buying a house. You have a house, you take a mortgage, you buy the house. Hopefully, your house is worth more than your mortgage. Now, the example is not 100% accurate on this because the balance sheet reflects cost minus depreciation, which we won't get into that now. But generally, you don't want to be underwater with long-term assets, things you're going to have for a long time, over a year, and debts that are due out more than a year. So let's see what their long-term assets are. $667 million. And their long-term liabilities, $303 million. Now, another thing that I want to know, so their long-term assets are much greater than their long-term liabilities. That's good, okay? However, they have a massive goodwill balance here. That's pretty significant. Goodwill is when you acquire. The only way goodwill goes up, as you can see right here, is if you acquire another company for more than the fair value of its net assets. That is the only way, at least that I know of, that goodwill increases on a balance sheet. So between December 31st, 2021 and September 30, 2022, they did some kind of acquisitions. That's something you should research, okay? But goodwill is a significant portion of their long-term assets. And remember Teladoc, if you acquire a company that's a clown company and you find out it's worth less than you thought it was, this number goes down bigly, and that reflects as a loss on your financial statements or on your income statement, and then your stonk will probably go down, just like Telestonk did, okay? They also have $239 million of long-term debt. Now, I wonder if they have their detail. Another thing to pay attention to, maybe we don't have time to do it in this video, but you want to see when this long-term debt is coming due. And are you taking notes, Scott? Scott, you watching this? Take notes. When your long-term debt is due within a year and you have a financial statement, you have to move whatever amount is due from here, long-term, to short-term. You see how you have debt maturing within 1 year? So theoretically, if all of this $239 million was due within the next year and a couple days, well, on the next financial statement, this number could potentially be right here. And suddenly, you have a debt time bomb. And what do you have to do? You either have to pay it off or you have to refinance it. And now we have Higher interest rates. That's right. So if you're looking at buying Corsair, my horse here, I would definitely check the long-term debt and see when that's coming due. Okay. Let's see. Additional paid-in capital went up. So, they issued more stock. What a shock. So they issued more stock. And, okay. So overall, not the worst balance sheet in the world. Areas I would focus on is, inventory turnover. How fast are they clearing their inventory? Because if they're not clearing it fast, if they run into trouble, they may have liquidity issues, have to borrow money. And I would check out this long-term debt and see when it's coming due and factor that into your calculations. And I would also see what the heck they're buying. What are they acquiring? Okay, their goodwill is a pretty big chunk of their assets. It looks like it's like 33% of their assets. That's pretty significant. Okay, acquisitions, bro. Okay, statement of cash flow. So, net cash provided by operating activities. They have positive operating cash flow, and it's actually improved year over year. That's pretty good. A big part of that came from collecting a huge chunk of accounts receivable. Okay, they had $133 million inflow from collecting accounts receivable. But if you factor that out, their cash from operations wouldn't be that great. So overall, I mean, they have positive operating cash flow. So they don't necessarily have to go into debt to pay for, short-term, they don't have to go into debt to pay for business activities. However, we can see they had some acquisitions, obviously, because we saw that. We saw the goodwill change. Payment of deferred contingent consideration. Don't know what that's about. They bought more property, plant, and equipment, and they've actually significantly increased their PP&E purchases versus the prior 9 months. So whatever, it looks like they're trying to grow, bro. They're trying to grow. Okay. Let's go look at the financing activities. So we can see they borrowed from a line of credit and then paid it back. They paid off a little bit of debt. They paid some more contingent consideration. They got $4 million over the last 9 months from employee equity incentive plans, stunk options probably. Yeah. So overall, the company still is unprofitable. Their revenue growth over the last 3 years is not that great. I don't see the big deal. I don't see the bullish change in this company. They had a slight improvement in gross profit. That's fine. But overall, this has always been a low margin business and they're still losing money. The earnings, I saw an article. It's like, they had positive EPS. No, they didn't. It's right here. Look, it's negative. They lost money. So you can't trust these clowns. Okay. All right. Let's do some comments. Revenue is king. Free cash flow has sunk my skunk. Bye. Revenue, my avenue, and forward PE. That's all he does. Can't wait for this deep dive on the balance sheets. I mean, I'm only going so deep into Corsair. I mean, I just did a cursory inspection of the balance sheets, and I've determined they're probably not going to go bankrupt within a year. But then again, you got to check that long-term debt. You got to check it. Even Chinese stocks are up today, bro. Chinese stocks, bro. Joke's on you, strong man. Corsair is only down 28% since the start of the year. Compared to trash, Meta, Magenta. Do you guys know I sold Meta at a gain? I did. I actually sold some stocks at gains. Everybody's like, oh, Baba went down. You're so stupid. I sold a couple stocks at gains this year. Doesn't matter, bro. Baba went down, bro. Revenue, my avenue, is the future, bro. I bought Corsair at 20. Ouch. LEFUFU was buying it in the 30s and 40s, I think. Because you're like, oh my God, the revenue grew because of the pandemic, right? Hey, strong man, how much soy do I have to eat before I'm feminine enough that you'll leave your wife for me? I gotta see a picture of you, Let's see. Corsair is not that. It was never great. Okay. It's a low margin, slightly unprofitable business with low free cash flow. Not impressive revenue growth. Not very impressive gross profits. I don't know, what's so great about it? Because they were profitable briefly during the pandemic. Let's see. Can you match it up to DraftKings? I keep hearing about DraftKings. What happened? Jeremy stocks will not survive next year's recession. I think Smile Direct will probably be the first to go bankrupt. And then what else would go? Out of all his clown stocks, Voyager went bankrupt. Smile Direct, I could see that going bankrupt. Tattooed Chef, it's getting close to that danger zone. Honest My Bonus, I think, is going to be fine. I haven't looked at it recently, but I think they had a good balance sheet. Corsair isn't going to go bankrupt, I don't think. Most of his companies probably won't, but there are some that are iffy, especially the one that he invested a lot in, Tattooed Truckers, you know what? That has a chance of going bankrupt eventually. Corsair is doing better than Meta, MyJetta, and Baba My Abba. Year to date. Okay, well, buy a low margin, unprofitable. How do I keep saying it wrong. Slightly unprofitable business. Go ahead, just buy it, bro. But it's got positive cash flow, bro. Jeremy said in one of his videos, his average cost, of course it is. Yeah, 16, bro, of course. He's such a clown. You know, he could also sell lots of shares, right? He could sell the ones that he bought at the top to lower his basis. There's all sorts of manipulations he can do. Or he's just funneling money into this company, like massively contributing to it. But remember when he started buying it in the 40s or in the 30s. It's freaking crazy what that guy does. And he's like, well, look at my cost basis now because I averaged down. Well, I mean, if you average down into any stock that's collapsed, your basis will be better. And then if it has a temporary rally, oh, look at me, I made money. Gaming accessory companies going to 100x. Yeah, definitely. I always thought Corsair was a good company, but it was overvalued. It's more respectable. But LeFuFu bought it, man. Come on. Stop reading cash flow. We know Jeremy didn't read that when he bought Corsair. He never talks about the statement of cash flows. Have you noticed that? It's always about the balance sheets and maybe the income statement every once in a while. Corsair, my holy smokers, you know what here? It's going to be like that revenue. You seem to hate clowns. I do. Ronald McDonald will come for you. I spend my Saturday in the aisle of GameStop and check how many people are buying Corsair. It's a buy. Baba will make you rich in 10 years. It might. I'm holding, baby. It went down, bro. It's the same thing as Tattooed Chef, bro. Massive e-commerce giant in China. It's the same thing as Tattooed Chef, bro. Tattooed Chef was Jeremy's old. My average cost basis in this is 0. Man, you are a hero. You're up infinity %. Let's see. Jeremy's average cost is 16 at which try. How's his weed code doing? Tattooed Chef or VTI? That's a tough choice. I don't know, Mr. Username. I have to. I'll get back to you on that one, okay? All right, that's it. I might do one more video. Does anybody have any suggestions in the comments for earnings? I don't really track this crap, so. Did something happen to DraftKings? Let's go. Drop in the comments. Planet 13 got wrecked. Oh, let me check real quick. The planet! Planet 13. The planet! Nice! It's the planet! It doesn't look like it got wrecked. Fell 4% today. Nothing crazy. Let's see. Adidas, Carvana. I haven't really looked at Carvana. What happened to Fartbox? Did Fartbox go down? Dropbox stock, bro. What happened to Dropbox stock? It went up! All right, I'll think of something, but I'm going to head out for now. Cheers!
Oh, merry stock market. Oh, man.